Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys 7 different companies that are trading currently they're below their intrinsic values. One of the companies is fairly valued, the rest of them are undervalued at the moment, which means they are trading slightly lower than where they should be based on the forward forecast. So what we normally tend to do is use the discounted cash flow models. Okay, so Morningstar uses discounted cash flow models to kind of predict where the company should be right now based on the future earnings and future cash flows and so on. And they came up with basically 6 different companies or 7 different companies that are currently either fairly valued or undervalued at the moment. But before I do that, I just want to talk about the S&P 500 and general markets first of all, because as you can see here, this is the S&P 500 a year to date. So since beginning of basically this time last year up until now, this basically the S&P 500 is up almost 28%. Remember, for the last 4 years, 2022 was the only year that we were down. The rest of the years basically was 19% or higher every single year, which is absolutely amazing. The Dow Jones is up 16%. The Nasdaq Composite is actually up almost 35% and 7% for the FTSE 100. So all the markets are up, and it is quite difficult at times to look around and find the undervalued stocks. So what I'm trying to do is now just highlight some of the companies that we are overlooking right now. And you will hear a lot about companies like the Nvidias and Broadcom and all of these companies that are, tech heavy, AI heavy kind of companies where people just, that's what this new shining toy that they're playing with. And sometimes we forget, we're here as a long-term investors. What we're trying to do is buy high quality companies below their intrinsic values. So when they are trading below their intrinsic values, that's the time to make money. And like I showed you last video, if you look at companies that I've talked about in that video that I own in my portfolio, if you haven't seen that video, go and watch it, where we talked about companies that are currently overvalued, performing really well, and companies that were not performing well at all. And one of the companies that we talked about was Broadcom. I was buying Broadcom where it was actually trading below this intrinsic value, and alhamdulillah, over the years, it's done well for me. That could potentially be, like if you do similar thing for these companies that we're going to talk about today, of course, you could potentially do the same thing. So I'm not saying go away buy them. I'm not a financial advisor. I'm not saying, I know everything, but just go and do your research. And if you genuinely feel these companies will add something to your portfolio, value to your portfolio, then of course, go for it. So let's talk about the companies. But before we do, I want to mention one thing, because all of the companies we're going to talk about today have one thing in common: the moat rating, the Morningstar moat rating, okay, which comes from this company called Morningstar, which is the way we're using their valuations, of course, this today. I want to talk about this because we haven't actually spoken about it for a while, and I've get questions a few times and say, okay, why does that really matter? And I want to talk about why it really matters. Okay, first of all, it says here, Morningstar Economic Moat Rating represents a company's durable competitive advantage. A company with economic moat can fend off competition and earn higher returns on capital for many years to come. And that's the important part. So if you are the main player and you can fend off all these competitions, potentially you can earn higher return on capital for many, many years to come. How do companies do them? There are 5 different ways basically these companies do these things. So first one is a switching cost. Okay, that just means a company like, for example, Salesforce, company like Microsoft and so on, or Amazon, AWS, whatever. I'm just going to use technology companies because they are the ones that a lot of that's quite difficult to switch from. Is basically, imagine if you're using AWS as your web services, whatever, for your company. It's not easy to move from that to Microsoft straight away because there's a lot of information that a lot of things are built around that. So same goes for Salesforce. If you use their platforms and you are part of their environment, it's hard to move that environment. Same goes for an Apple, for example. If you use an iPhone, for example, it's not easy to migrate from Apple to Samsung, for example. So that's the switching cost. Okay, the switching cost for companies a lot. So for that reason, they actually stay with the company. The network effect, okay, because when the value of a company's service increases for both new and existing users as more people use it. Visa and MasterCard is one of those great examples because the more people use their product, okay, the more people know about it, and basically it becomes the industry standard kind of thing. Okay, and Visa is probably one of the best examples to use in that situation. The next one is intangible assets are things such as patent, government license, and brand identity. And this is the most important part, the brand identity part for me. The patents is okay. A lot of companies, like for example, pharmaceutical companies, have that, so it's not easy to anyone else to copy that. And that's why we look for companies that have for example, Merck, for example, has got a drug that no one else can basically produce right now until their patent runs out in, I don't know, for however many years. Okay, the brand identity could be, for example, as simple as a Starbucks. Starbucks is one of those well-known brands. Everyone knows about them. And if you open Starbucks in a place where there's a lot of other coffees, most likely people will come to you because of that brand identity. Okay, so they have a basically competitive advantage over their competitors. A company with a cost advantage can produce goods and services at lower costs. This is quite common for companies like Walmart, companies like Tesco in the UK, just to reduce the cost, because they sell in a lot of these products. It's easier for them to basically lower it, allowing basically to undercut its competitors or achieve higher profitability. So that's again a very good advantage. Efficient scale benefits companies operating in a market that only supports one or fewer competitors. Great example of that is railroad companies like Union Pacific, for example. It's very difficult to build the track from scratch. So they already build those basically the tracks, and they've had it for hundreds of years, and they're gonna have it for another hundreds of years, because it's quite hard to get into that market, because you have to do the whole track set up and all of that stuff. No one wants to do that unless you're buying another company from scratch and so on. So that is basically just kind of in a nutshell to give you what this economic moat rating is all about. And it is really important that all the companies that we're going to look at today, all of them have a wide economic moat, which means they are the player when it comes to that side of that, basically, or based on their markets and so on. And the first company we're going to do, I'm going to do a very quick summary. I don't want to make the video too long. So the first one is TSMC. TSMC basically is one of the companies that without this company, potentially we will not be able to do a lot of the advancement in terms of technology and sciences without this company. So NVIDIA basically makes or designs their chips, and this is the company that makes it. And ASML is the company that sells the product that this company uses. So the machinery is produced by ASML. This company then actually produces the actual chips and then gives it to basically AMD or any other company, and then they sell it to whoever they want to sell it to. This company is basically heading towards now that 1 billion market cap, just like Broadcom did a couple of days ago. And when it comes to dividend, is not the greatest, but the company has done absolutely amazing job in the last 5 years with regards to revenue and EPS. Profit margin, return on equity, and return on invested capital is absolutely amazing. $25 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 26%. Revenue growth estimate for next year is 25%, and then EPS about 26%, which is absolutely huge. It's fairly valued right now. That's why I've included it in here. $215 per share is where they think the price should be. Is below that right now, $200 per share. So this is a very, very interesting company. I know a lot of you said you can't buy this on the basically trading 212, but you can on basically interactive brokers. Right, the next one is ASML. I've already kind of mentioned this company, probably one of the best companies out there. 283 billion market cap. Current price is $718 per share. Dividend is decent. And in terms of the profit, in terms of the 5-year growth rate for the revenue and EPS is absolutely amazing. Profit margin, return on equity, return on invested capital. There's not that many companies that can do this. Free cash flow, $3 billion right now. Total return the last 10 years is 22%. Revenue growth expected to grow about 15%. EPS is expected to grow about 22%. 23% discounted right now. $935 per share is where they think the price should be. Right now it's only $718 per share. Next one is Adobe. Is another company that has been hit hard. This is probably one of the companies that I've got a video coming up, inshallah. I will do that in the next couple of days. But it's one of the companies that I genuinely think people kind of misunderstand to this company's earnings. I know there's a situation with potentially with AI and Canva and other competitors doing basically taking a market share of this company, but this company is not going to disappear overnight. They also have, hand in when it comes to the AI kind of situations. Everything about the report that they've reported recently was absolutely fine. The only thing they basically when they were expecting is the guidance was slightly lower than what they expected, and for that reason the stock went down. They don't pay any dividends right now. The 5-year when it comes to revenue growth is 15%, EPS about 19%, profit margin, return on equity, return on invested capital, probably one of the best out there. Free cash flow $6.5 billion, total return 20% in the last 10 years. Revenue growth for the next year, they're expecting about 10%, 13% after that, which is absolutely amazing. 21% discount right now, $590 per share is definitely what they think the price should be. I genuinely think this is probably one of the best companies out there. Again, I do own it, so I might be being a little bit biased. Is on the family portfolio. If you want to check the family portfolio, join us in the Discord, basically where you get access to basically the Patreon, where you get access to a lot of things, including the Discord and of course the family portfolio and so on. Next one is another one that I own, and that is AstraZeneca. There's a bit of a situation with the CEO and basically people from China side of things, and I think we'll see what happens with that situation. There's an investigation going on by the Chinese government and so on, so we'll see what happens with that. But for now, I'm not really worried about this company. I really like the business model. I will be holding on to my shares, potentially adding to it. You get 2% dividend, 2.2% dividend yield. In terms of the 5-year growth rate when it comes to revenue and EPS is absolutely amazing. Profit margin, return on equity, return on invested capital, absolutely wonderful. Almost $7 billion of free cash flow right now. 8% when it comes to the total return in the last 10 years. Revenue is expected to grow about 7%, EPS about 15% discounted right now. $78 per share is where they think the price should be. Right now is only $66 per share. The next one is another one that I also own in this portfolio, is Merck. This is probably one of the best companies in terms of pharmaceuticals, one of the biggest one out there. They've got a drug called Keytruda. That's basically their main selling point, and they do have a lot. Their portfolio of basically drugs is quite diversified. So they got loads of smaller drugs that are selling at about $1 billion, and then they've got Keytruda, which is the main basically breadwinner if you think about. 3% dividend yield. It hasn't been hitting that 3% yield for quite some time, which is interesting now. The payout ratio is only 51%. The 5-year growth rate is about 8% and 13 years of increase in that dividend. $3.24 is what you get. B+ rated when it comes to dividend safety. In terms of the revenue compounded annual growth rate for the last 5 years, we're looking at about 11%. EPS, we're looking at about 50%. Profit margin. EPS, I don't think that's organic. I think that includes basically the company that they've basically acquired recently. Profit margin 19%, return on equity 28%, return on invested capital 23%. Free cash flow almost to $15 billion. Total return in the last 10 years, we're looking at about 8%. Revenue growth for the next year is about 6%. EPS about 23%, 15% discounted right now. $120 per share is where they think the price should be. We've got 2 more. If you haven't pressed that like button already, please do so. It really genuinely helps the channel. Right, the next one is Kenvue. This is a spin-off from J&J. This is the consumer basically product side of things. So the J&J did a spin-off, so pharmaceutical company and the consumer products. So all the consumer products is now Kenvue. This is 42 billion market cap, so it's not small at all. $22 per share right now. You get 3.7% dividend yield, 68% when it comes to the payout ratio. There's not a lot of information over the last 5 years because it's very new. The spin-off was quite new. The profit margin, return equity, return invested capital is decent. It's not a lot, but I'm sure it will grow in the next whatever years. Free cash flow right now, we're looking at 1.4. Revenue, they expected the revenue to grow about 3%. This is the type of business that will grow about 3.5 to 7.8% every single year. You can't expect more than that. They are consumer staples in the end of the day. EPS growth, we're expecting about 6%. In terms of the Morningstar valuation, they're saying 15% discounted right now. $26 per share is where they think the price should be. And finally, we're looking at UPS. This is probably one of the companies that are basically undervalued and underperformed the general markets over the last whatever year and a bit. and a lot of it is because of the unionization and all sorts of things that's going on with the business. Right now it has a market cap of $109 billion. It has a wide economic moat. In terms of dividend yield, 5%, just above 5%, which is crazy. The payout ratio is very, very high, 87%. They need to bring this down. They do have some free cash flow, so it would be interesting to see how that goes. You get $6.40 and 52. I don't think, by the way, it's 15 years. I think it's actually, no, I think it is 15 years. $6.52 is what you will get for every share of this company that you own. Now, revenue growth side of things and EPS is not that greatest. Profit margin, return equity, return invested capital is okay. Like I said, they've got $4.3 billion free cash flow right now. Total return the last 10 years, looking at about 5%. They expected the earnings to grow about 4%, but EPS expected to grow about 17%, which would be really good. If that happens, I think that will help the stock to basically bounce back. 14% discounted right now, $150 per share is where they think the price should be, but it is right now $128 per share. Before I just stop the video, I'm just going to quickly show you from Sharia compliance side of things. Nothing to worry about in any of these companies. The highest you can see here in terms of interest bearing debt is this one here, UPS, but that's about 23%. The rest of them seem fine. Now, that's the 7 companies I wanted to share with you guys. These are based on the Morningstar valuation. Again, you do your own research. Add another, depending on how much you think these companies are overvalued or basically how risky they are. You might want to add, say for example, companies like Adobe and ASML, and these 3 might be very volatile stocks, and you might want to say I want at least a 10% on the top of basically whatever. So that means you can still buy it, but with this one you might want to wait for basically a drop, maybe like the 5%, 10% before you buy it. But these 2 you should be able to, if you have the 10% basically margin of safety, you can actually still, we do, by the way, the reason we do margin of safety is because just in case you are wrong about, or they wrong about their calculations, because remember, all of this is estimation. We're estimating the future cash flows, the future earnings of the business, but only Allah knows what's going to happen. So just in case something goes wrong, you want that margin of safety. That's the reason we do it. Anyway, if you haven't joined us at the Patreon account, please do so, because it really genuinely helps the channel. There's a lot of subscriptions that we pay for, that basically all the information that we use comes from the subscription websites. So we would like to, of course, pay for that. InshaAllah, if you can help us with that, that would be absolutely amazing. I've got a lot more videos coming up in the next few weeks, InshaAllah. Just keeping, I've got a bit of time off, so hopefully I will be sharing a few more videos with you guys. If you're enjoying the content, let me know, InshaAllah. If you are new to the channel, of course, welcome. And if you're buying stocks next week, let me know. Put it on the comment section, so just to share it with the community, InshaAllah. And I will be sharing with you guys what I'm buying and selling, InshaAllah, as we move forward. Have a wonderful day. Assalamu Alaikum.